Hello, and welcome back, guys. So, Disney reported earnings and they are doing tremendously well. They are up 10% actually pre market. So, we'll see what happens, of course, once the market opens up. But what happened? Why this insane increase? Why 10% of an increase in terms of Walt Disney and their earnings? We're going to examine the finer details and, of course, always take a look on whether it's a good idea to be buying this stock right now. So, first things first, let's take a look at the stock news for the company. So, things that we see here: Disney earnings suggest the streaming wars are finally over. Disney stock rallies on strong earnings. Disney's latest media streaming move could be huge, and all that stuff. So, let's examine the details though about the earnings report now. So, Disney streaming subscriber growth blows past estimates as company beats on top and bottom line. They posted better than expected results on both top and bottom line. That is revenue being the top line, and bottom line is the net income, in case you're not aware. And on Wednesday, the Walt Disney Company reported that total Disney subscriptions in Disney Plus, that is, rose to 152.1 million during the fiscal third quarter, higher than the 147 million analysts had forecast. Very, very interesting. It seems like the company is doing better than Netflix, actually. So let's take a little bit of a look at the finer details here. Now, they did report again this 5 million increase in terms of their subscriptions here. Increase based on the actual analysts' forecasts, actually. It was actually 5 million more. And at the end of the fiscal third quarter, Hulu had 46.2 million subscribers, ESPN 22.8. So combined over all of these, they have 221 million streaming subscribers. That's a lot, as you can understand. Netflix, long the leader in the streaming space, had 220 million subscribers according to the most recent tally. So this means that all of these other streaming services are actually getting a big chunk of what would be potential Netflix earnings. So that's important. We're looking at a lot of competition here, and Disney seems to be doing rather well, and this seems to be the whole spirit of this earnings report here. And the whole jazz is all about what Netflix and Disney and Hulu are doing right now. Now, you will see, and we have heard about it, the fact that Warner Bros. Discovery, for example, and Netflix have had a pretty much a drop in subscribers. And while they do expect that they will rebound at some point, there is some uncertainty, as you can understand. Now, you will see here that starting December 8 in the US, Disney Plus with commercials will be $7.99, and without, which is currently the price of Disney Plus without ads. The price for of ad-free will be $10.99, which basically points to all these companies shifting to a pretty much commercial model, ads model, in which they will be having sort of two tiers of subscriptions. One in which people would be watching ads. I don't know why anybody would do that, actually. And the other one in which people will actually be paying a little bit more to avoid all the ads, which I would definitely get myself if I had the option. But yeah, it looks like there is a shift towards that from all these streaming services. Netflix was also one that is going to be doing that, and it has been discussed for quite some time here. So the thing that we wanted to see now is take a look at the results here of what exactly happened with the earnings report. Now, $1.09 dollars per share versus 96 cents, so a pretty nice beat over here in terms of the EPS of the company. A revenue of 21.5 billion versus 20.96, a pretty handsome beat over here as well, about half a billion more. That's actually pretty nice. And in terms of total subscriptions, 5 million more. Again, very nice to see for the company. And what about the Disney Parks experience and products? As you'll see, the revenue increase of 72%, which is absolutely insane here. You can kind of understand that after the whole world actually exits the COVID pandemic. People would want to have some of their entertainment back, and all these attendances will have increased. And so this makes a ton of sense why you're looking at this kind of an increase here. It is absolutely to be expected right now. So yeah, the company has been doing rather well, as we can see over here. We can just real quickly take a little bit of a look at our tool here and just see what is happening with the senators here and insiders. Not an insane amount of action, some sales and some purchases here, but you will see that Christopher Jacobs over here sold a small lot. We don't know the exact number. They never actually file the exact number. It's always a range. And in terms of Scott Franklin, they bought a little bit, and Earl Blumenauer. So yeah, there's a little bit of a buying, a little bit of selling. Nothing in particular here that would be too interesting. And in terms of insiders, you kind of see usual stuff, some awards here, some options and things of that sort. Nothing out of the ordinary, and you will see that the securities transacted are a small percentage of the total securities owned as well, which means that the insiders are actually not really selling the stock right now, at least in big lots. Interesting to see as well. But let's jump to the actual metrics of the company next. Let's see what's happening with the actual valuation of the company. A 74 is the current PE ratio, which of course, as you can understand, is rather high, 74.5. And the price to free cash flow is even higher here, with the company also diluting shareholders a little bit, pretty much issuing a little bit of extra common stock. And take a look at this total liabilities to free cash flow. This is very, very elevated here. So this points to a company that is too much in debt, and that could be problematic here. So we will examine that in a little bit more detail, but a lot of total liabilities here for the company. So we need to know more about this one. Now, in terms of the revenue growth, the company has been increasing the revenues, not at a tremendous pace, but overall they have been increasing it. But net income growth has been going down, as you'll see. Same with the free cash flow growth. Now, part of it could definitely be the pandemic that we had, as understandably you will see that it has fallen in these years, like from 19 to 21. So this makes a ton of sense. I wouldn't be too worried about this one because we know this was some special occasion here that's not going to be sustainable forever. So the company will more than likely, come back to their normalcy. So the other things here, the debt in comparison to equity looks fair, but remember the total liabilities in comparison to the free cash flow looked very elevated here, which is what we want to examine. It's very, very important to see what causes this. So let's actually jump to this one and take a look at the financial statements. And I want to start with the balance sheet in this one, just because the total liabilities look tremendous. So the total liabilities that the company has over here, they're sitting at $110 billion. That's a lot of total liabilities, really a lot. And the actual debt of the company is sitting at 57 billion. Now, the company, if we go back in the cash flow statement, you will kind of see here that it was making like 2 billion pretty much in last year. Now, this is not representative of what the company can actually make, because there was a steep decline, again, the pandemic years. So the company does make about 10 a year. But remember that even though we're looking at a 50 here, that again happened because the company was making much less free cash flow in the past few years, past couple of years. Overall, this is going to be an about 10, practically speaking, because again the company will be making near 10 billion normally in their usual days, and the total liabilities that the company has in terms of their balance sheet, they're sitting at about 100 billion here. Now, I do want them to lighten up this one, so it's going to be a little bit more than 10, 11 or so. So I do want them to lighten this up a little bit. This is very hefty here. They have taken a lot of debt lately, especially 2019, that is. So they have taken a lot of debt, and they would probably need to resolve a little bit of this one. This is quite substantial compared to what the company is generating. And especially when they have this kind of slumps, if they continue happening, hopefully they won't, this can cause issues with the company. And so we need to be careful about these things happening potentially. Now, in terms of the income statement, again, what we talked about, the company has been increasing the revenues overall. And in terms of the net income, it has gone down because of the pandemic years. Again, understandable. We do fully expect them to recover to these levels, I suppose. 11 to 12 billion in terms of net income is what they should be doing and what they will be doing normally. So yeah, we will just consider this situation, this current this current financials of the company for the past 2 years happening because of COVID, and it makes a ton of sense. So we will just assume that things are going to get better, which they probably will. Actually, it makes a ton of sense. Now, in terms of the stock evaluation too, how much should we be paying to buy this company for? The revenue growth has been at about 3-4%, something of that sort. So we're going to go with these levels, 3, 3, and 4, which I think makes a ton of sense for the next 5 years. In terms of the net income margins, you will see that understandably, again, they have been suppressed lately because of the pandemic stuff. But overall, they are sitting at about 15 to 20%. So I will actually go a little bit less, but not too much less, because I think the company will eventually go back to these levels. So let's just try 12, 14, and 17, see what we're getting out of this. In terms of the free cash flow margin, they're sitting at about 100 in their normal years, maybe a little bit less. So we'll go 80 and 90 and 100. And in terms of the annual return, 13%, our usual here, our typical. So what are we seeing here? Yeah, so we are looking at a company that is expensive and quite expensive actually. So we definitely would want to be getting it at a better price, and the current price is actually going to be even higher right now as the market it opens up. But I would, frankly speaking, expect it to be even more expensive. It's not. It's actually not as expensive as I would think, but it's still very expensive for what we'd want it to be. Probably something near 70 would make some sense for Disney. Uh, I don't know if I would want to give it a little bit of a premium. Probably not. Maybe somewhere between these two, 60 to 70 would probably be the sweet spot for me. These are fair valuations here, fair projections, I'd say, and I think they are very, very likely to be happening for the next 5 years. So I would probably have to go around these levels and not really where we are right now, which is probably something like 100 and what is it, 25 or something of that sort. Yeah, 123. So this is gonna be a little bit more expensive than what I would want it to be, but it's a great company, and I will be watching for it. Maybe we're gonna get a better price, and it's been down significantly in the past year. It's yeah, it's still 40%. It's probably going to be like 30% or something of that sort after today, but yeah, it's still rather expensive regardless. So thank you for watching the video, guys. Remember to leave a like and subscribe if you're not a subscriber already. And I'll see you in the next video. In the meantime, take a look at the video that I created earlier, and I'm talking about Invite, a stock that was up 300% yesterday. So take a look at it. Very, very interesting video to watch and see what happened and whether this one is a buy still. Thanks again, and I'll see you soon, guys. Bye-bye.